Good day. Before I hand over to John, I would like to talk for 10 minutes about global regulatory developments in the insurance world and how these may affect Guernsey. The global financial crisis was first and foremost a banking crisis. However, regulators soon came to ask themselves whether insurance companies might also pose the same sort of threat to global financial stability as had banks. Indeed, one large insurance company had to be rescued by the US Fed at some cost to the US taxpayer. This one failure deepened regulatory concern. The global regulatory architecture for insurance differed markedly at that time from that for banking, though the two have since come closer together. Whilst banking was thought of as absolutely central to any economy, not least for the multiplier effect, this was less clear for insurance companies. Consequently, insurance companies were often regulated by government departments whose main function was consumer protection rather than financial stability. Whereas the Basel Committee at that time, at least, was dominated by the G10, the International Association of Insurance Supervisors, IAS, was a far more broadly based body, also more open to industry participation than its banking counterpart. So regulatory concern about insurance companies was therefore not easily dismissed. Issues of regulatory knowledge and control were relevant, but so too was the absence of any global capital standard, the presence of large global companies, especially in the reinsurance sphere, the sheer size of the global insurance asset base, and the often unclear use of derivatives and highly leveraged transactions. It was therefore unsurprising that the new overarching regulatory body, the Financial Stability Board, chose to include insurance risk in its core mandate. Now, after several years' focus, some of the original concern about insurance companies has gone away. Insurance companies are seen to be fundamentally different from banks, due, for example, to their long maturities, at least for life, the depth of reinsurance available, and the double protection offered by reinsurance and the limited use of derivatives. Regulators also came to recognize that in key areas such as life reserving, INBR and asset selection, insurance companies had a history of conservatism. It was also accepted that general insurance rarely threatened financial stability. Indeed, for some, insurance companies are seen as part of the solution rather than the problem, insofar as they take on more long-term, non-traditional assets, though there are also dangers here. Nevertheless, some regulatory concern about insurance companies remains and has largely materialized around capital for large international firms. The main issue is the continued lack of any agreed global capital standard. And for this reason, IAS is now working towards such a standard by 2019. And in the meantime, a crude approach is being applied to a smaller group of firms and is likely to be supplemented by an additional capital requirement. Now, it's unclear as yet as to how the international capital standard will be calibrated, whether it will have any impact on actual capital levels, and whether national regulators will be able to police a level playing field. Other regulatory themes remain alive. One is the determination of regulators not to allow insurance companies to engage in any significant way in non-insurance activities. Another is the possibility of developing a resolution scheme along the lines of that for banks. This, of course, again raises the question of capital resources. We are still in the foothills of this, but we can be confident that what regulators think is good for banks has to be positively disproved insofar as insurance companies are concerned. Another emerging theme in IAS is greater interest in conduct and consumer protection. Cross-border issues may be even more difficult for insurance companies than banks. What in practice does it mean, for example, when life companies have to be backed by appropriate assets? Why is it that whilst in the European community regulatory practice is converging, in the US it remains state-based? So what does all this international regulatory issue mean in practical terms for Guernsey? Well, in the immediate sense, It may not mean that much. We're just too small to matter, and some of our key insurance sectors are specialized. But in other areas, there may be implications, albeit long term. We are likely to have eventually an international capital standard, and here we'll have to watch Solvency II, simply because there is at present no other cross-border approach on these lines. Cross-border resolution issues may also come to the fore, and we have several life companies that operate outside Guernsey. How would we stand if a local protection fund became mandatory? How might consumer concerns and greater autarky affect the use of third-party brokers? Will we be able to ensure a reasonable regulatory approach to PCCs, ICCs, and captives in the wake of calls for greater standardization? Well, a few of these questions are immediately relevant, given the slow speed at which global regulation moves. However, it would be wrong to believe that we are somehow forever insulated from all of this. Finally, and predating the 2007 crisis, we in Guernsey are already busy implementing the new insurance core principles in Guernsey. The latter continue to evolve, not least as IS issues more detailed guidance under the ComFrame banner. For example, we are currently concerned that group supervisory requirements are now being threaded through several of the international core principles, rather than staying under one international core principle. This means that a host regime like ours risks being marked down on several ICPs rather than just one. This is one immediate example where international developments do affect the bailiwick. And at the Commission, we try to keep in touch with the above developments given our limited resources. I sit on the IS Technical Committee and chair the group of International Insurance Centre Supervisors, or GICS. And last month, the Director General was elected by GIPS to the IS Exco. Caroline Bradley holds the pen on the IS Captive paper. All of this helps us to see the way the wind is blowing, and even, I dare say, very occasionally, blow it in the right direction. So, to conclude, I see no immediate threat to Guernsey from post-2007 regulatory developments, though neither do I see business opportunities. However, I cannot say that this will always be the case, and clearly we must continue to keep ourselves in the informational loop. Thank you.
Thank you, Jeremy. Good morning, everyone. For those of you who do not know me, I'm John Dunford. I'm Deputy Director of Banking and Insurance Supervision and Policy Division. As most of you know, I returned to insurance to hold the fort for Caroline Bradley whilst she's seconded to the Channel Islands Brussels office. I must say it's good to be back, and what a lot is happening. I think I understand why Caroline may have volunteered to go to SIBO. The areas I'd like to cover this morning are fourfold. Firstly, I'd like to do a review of 2014 activity, then have a look forward to 2015, have a look at PRISM in practice. My apologies to some of you who may have been here for the banking presentation, but there may be a little bit of repetition there. And then just have a look at one or two other risk matters that I'd like to discuss with you. So, review of 2014 activity. I'd like to review statistics, how we've delivered on streamlining of workflows, commitments we made at last year's presentation. Look at the solvency framework and how that's developing. Look at some other ICPs. Touch on recent stress testing. And then something that I know all of you will know dear to my heart, the impact of UK GAAP changes. I will try and keep you awake during that bit of my presentation. So first of all, let's look at statistics. At the end of 2013, gross written premiums, gross assets, and net worth were steady compared with the prior year. The majority of growth is still in sales, specifically, mainly insurance-linked securities. This graph shows the growth in the number of international insurers over the past 10 years. Currently, there are 809 international insurers. We broke through the 800 barrier in June. And I must say this reflects the continuing drive and innovation shown by you, the insurance managers, coupled with a well-regulated environment. We continue to deal with a large number of applications each month, the quality of which I will come to later. This graph shows a steady growth, due mainly to the cell growth, as I've said. In 2012, you'll see there was quite a sharp increase. This was mainly due to the UK mortgage indemnity scheme sales, whereas in 2013 and 2014, it's mainly due to the insurance-linked security sales. But there is also growth elsewhere, not least in the use of captives for the first time in many years. New business. In the 12 months ended September 2014, there have been 95 new international insurers compared to 79 in the previous 12 months. This includes 57 PCC sales, 16 incorporated sales, and 9 captives, which, as I've noted earlier, have been in steady decline for some years. In addition, we have welcomed the licensing of one more insurance manager, which is the second in 2 years. There have been 64 surrenders in the same period, but 39 of these were in December 2013, when 32 dormant cells were closed. So where does this new business originate from? Let's have a look at the type of insurance cover that's being written, and this is the last 12 months, and it's by the number of insurers, not by any other measurement such as premium. The type of cover being written is dominated by catastrophe cover of various types in ILS cells. Also of interest and new to this chart is longevity cover, initially through the launch of the BT pension scheme insurer, which has sparked considerable interest for further insurers from pension schemes and actuaries. And we have a number of related applications either in the pipeline or being discussed with us. KNR, ATE, and pilot's loss of license cover continue to feature in addition to an insurer owned by a power utility group covering the damage caused by bushfires in the Australian outback, and a European football club insuring the cost of it failing to get into the 2015-2016 Champions League. This chart shows the geographical source of new business over the past 12 months. The dominance of the UK as the main source of business has reduced due to the ILS business originating mainly from Cayman, Ireland, and Switzerland. Looking at all 809 international insurers, this shows where they come from, and there's no real surprises here. It shows the dominance of the UK, as would be expected, but also the growth in Cayman over the past few years, again associated mainly with the ILS business. So let's move away from statistics and have a look at the promises that we made last year. Streamlining of workflows. Last year we promised to deliver on streamlining of workflows in these areas. The first 4 items, business plan changes, loans, PQs for cell controllers, and directives and alternatives were addressed in guidance papers issued in January 2014. I'm pleased to say that we are seeing the benefits of this in a reducing number of routine inquiries and correspondence. So thank you. We've already introduced fast-tracking authorization for ILS and other fully funded entities in certain circumstances. We are also engaged in discussions on whether specific legislation in relation to ILS business is required. The streamlining of annual returns is linked to our revised solvency framework and to the Commission-wide project on online submissions. However, we are confident that the annual return process can be streamlined, particularly for captives. We've already streamlined the processing of annual returns, resulting in us being able to identify key risk indicators as soon as the annual return is received. On the risk-based solvency regime, the new regime will be operational from early 2015. Close coordination with the Policy Council, the states, GEA, and the Commission is required and is in motion. The rules and feedback paper will soon be issued. Legislative changes are in motion as well. As long as there are no further challenges, we will instigate a soft launch at the end of February 2015. After consultation with industry, the plans to replace the Corporate Governance Code with rules has been withdrawn. And instead, a revised code has been drafted in line with ICP 7 and 8. This will be issued soon. Proportional application under a code format should address any concerns industry may have had with respect to specific corporate governance provisions and their possible rigid application under a rules format. This new code will be published at the end of February 2015, but will come into effect on the 1st of January 2016 to provide sufficient time for compliance. We have consulted in the area of public disclosure. The changes will only be of concern to the larger commercial firms, and by that we mean a firm writing more than 5 million of premium or £25 million of technical provisions. Captives are exempt, as are reinsurers. We have recently written to each of the licensees we believe will be impacted. Disclosure only covers the audited financial statements and not an additional briefing document as originally proposed. Stress testing is already being used to some extent in the OSCA. However, in future, specific stress testing will be applied to life companies to calculate solvency requirements. In addition, we continue to apply across-the-board stress testing to key insurance firms. The last time in 2010, and again this year. The deadline for responses was 31st of October, and the results are in the process of being reviewed. UK GAAP is changing for accounting periods commencing 1st of January 2015. For insurance companies, additional disclosures are required under FRS 103, which will result in significant resource requirements and additional costs. For captive insurance companies, the additional disclosures will not necessarily provide meaningful information that is not already available to key stakeholders. That additional information can be requested by both the parent and the Commission if required. It is here that I would like to thank GEA and the GSCCA, with whom a solution to the additional disclosures has been achieved. A lot of work has been put in by the Commission, GEA and GSCCA. If licensees are not intending to follow IFRS and wish to consider an alternative form of accounts by excluding the additional disclosures under FRS 103, amendments have just been made to both companies law and the IBL by way of regulations in order to address this. It is possible for captives and others, such as PCCs, to request a derogation from the Commission from these additional disclosures under the IBL and to prepare an alternative form of audited financial statements. Guidance is on the Commission's website, which will assist in identifying which insurance licensees can approach the Commission for such a derogation. If this has not been done already, the guidance also includes details of the steps to be taken by licensees. It is not intended that the derogation will weaken the audited financial statements. Following the issue of the derogation, the board of a licensee will need to agree to the waiver of an audit under companies law. The waiver will need to be registered with the registrar before the end of the current accounting period. In order to exclude the additional disclosures, licensees will need to be exempt from audit under companies law, which requires the financial statements to be prepared on a true and fair basis. The alternative form will be prepared on a properly prepared basis. In order to ensure that the director's responsibilities are not weakened, which will be excluded from the companies law via the audit exemption, the Commission requires these responsibilities to be brought back in via a standard condition on the licensee's insurance license. As part of the derogation, the Commission will therefore require licensees to agree to a standard condition on the license. This is again explained further in the guidance. If a licensee is considering requesting a derogation from the additional disclosures under FRS 103 and has reviewed the guidance on the Commission's website, they can discuss this with the Commission, normally via the insurance manager. A number of insurance managers have already submitted lists of their licensees who they believe will qualify for derogation. Also, if a derogation under the IBL is agreed and an audit is to be waived under the company's law, please ensure you speak to your auditor. Looking ahead to 2015, looking ahead to 2015, as well as continuing business as usual of supervision under PRISM, the key continuing initiatives will be the revision of laws project, within which we will ensure that our IAS core principles gap analysis is linked, implementation of the risk-based solvency regime, training for ourselves and industry on using and interpreting the results of the risk-based solvency regime, and obviously some insurers preparing financial statements on a properly prepared basis, not true and fair. I'd like to move on to supervision under PRISM. We mentioned at the last industry presentation that the Commission would be switching to a new impact and risk-based supervisory framework in 2014. This framework is PRISM, the Probability and Risk Impact System, and insurance were the first regulatory division to adopt PRISM in late 2013. Risk-based supervision starts with the premise that not all firms are equally important to the economy and that a regulator can deliver most value through focusing its energies and finite resources on the firms that are most significant and on the risks that pose the greatest threat to financial stability and consumers. Our first step, therefore, has been to classify all of our insurers into 4 categories of impact: high, medium, low, and low. Impact indicates the degree of damage a firm could cause the financial system, economy, and population were it to fail or to engage in persistently poor conduct. Our subsequent engagement with a firm is driven by its impact level. So those classified as high impact can expect to see the Commission more regularly than before and with a greater focus on detail. Conversely, those firms classified as low impact will not usually see the Commission unless there's been an adverse event. A large percentage of international insurers, as one would expect, classified as low impact, but there are a number of high, medium-high, and medium-low. The cycle of engagement for these insurers is lengthier than you're currently used to, covering areas such as business model analysis, governance reviews, financial risk reviews, and in-depth discussions with senior management and directors. When we do engage with you, we will come on site and look at 10 different risk categories. Now, the observant of you will realize that there are 11 risk categories on the screen. The 11th, financial crime risk, will be the subject of a separate cycle of visits from our financial crime team. From these periodic engagement tasks, we will be able to form a view as to the level of risk in a particular area and may require a firm to reduce that specific risk via a risk mitigation plan. Finally, the conclusions reached by supervisors are now subject to internal challenge at cross-commission risk governance panels in order to ensure that the conclusions reached and any outcomes are consistent and proportionate. In 2014, the insurance team will present at 7 risk governance panels, of which 6 have already been held. And we will be holding a further 6 risk governance panels in 2015 based on our current plans. I would like to thank you for the assistance you have given the insurance team during risk assessments, on-sites, and preparation for the risk governance panels. Moving on to other risk matters. Having returned to insurance, I have witnessed with some concern some areas of risk that, although mentioned by Caroline last year, are worth repeating, plus some new observations of my own. As I've previously said, on average, the insurance team is dealing with 10 applications per month. The level of due diligence that accompanies applications undertaken by insurance managers is sometimes inadequate and unacceptable. Yes, the Commission has access to information not available to insurance managers, but simple internet searches often identify issues which the manager should have been fully aware of. In addition, PQs are not checked to ensure they contain all pertinent information or that they have even been signed. Sense checks of business plans and projections should often identify issues which the Commission is picking up and which therefore delay processing of the application. Examples are the business plan stating that the programme will be fully reinsured, but the projections show no reinsurance. Claims are estimated in the business plan to take 18 months to settle, and yet projections and cash flows show settlement of claims immediately and no claims reserves in the balance sheet. We recently had a PQ that failed to disclose information about former convictions easily sourced on Google. We even had an applicant who had been economical with the truth as to why his previous insurance company in another jurisdiction had been placed into liquidation. On checking with that jurisdiction, that jurisdiction's regulatory authority, it transpired that the regulator had placed the company into compulsory liquidation due to breaches of the insurance law. Undertaking such due diligence takes valuable resource away from supervising insurers. It is not uncommon to receive an application, particularly at this time of year, with a request that it be dealt with as soon as possible, as the manager has promised a turnaround within 2 weeks. Our service level standard is to give in principle approval 28 calendar days after receipt of an application, and we regularly beat that standard. Service level standards are disclosed on the GFSC website. The Commission reports on the performance achieved for 43 standards, of which 15 directly relate to insurance. In conclusion, we have reviewed the activity of 2014, including a specific number of applications, and including a significant number of applications, and the first time that the number of insurers has reached over 800. We have briefly looked forward to 2015 and the practical application of the risk-based solvency regime. We have revisited the introduction of PRISM and the impact and risk-based supervisory framework. Finally, I've briefly touched on some other risk matters and our service level standards. Jeremy and I would be happy to answer any questions you may have.